Hello everyone, I just wanted to provide you with an update on Murray Income. At the moment we have 52 holdings, around 3/4 of the portfolio is invested in large cap companies and 1/4 in mid cap companies. Our overseas listed investments represent 19% of the portfolio. Being able to invest overseas is helpful in terms of finding interesting high quality companies in industries that are difficult to access in the UK. Examples of this in the portfolio would be L'Oreal for cosmetics, Novo Nordisk for diabetes and obesity care, LVMH for luxury goods, and Microsoft for technology. Turnover is generally low, so there haven't been any large shifts in positioning over the last few months. So we're still very much focused on maintaining a thoughtfully diversified portfolio, that's both from an income and capital perspective, of good quality companies with robust balance sheets and strong competitive positions that are able to grow their earnings and dividends over the long term. For example, at the moment, our top 3 holdings are RELX, AstraZeneca, and Unilever. We also have a strong focus on ESG characteristics, and that's why we don't own any tobacco companies and have a AA ESG rating from MSCI, which ranks us in the top 5% of funds in the peer group and the top 1% of the global universe of funds. Looking at portfolio changes worth mentioning since the summer, given that we've been actively buying back shares, we've been net sellers. We've sold 3 relatively small holdings. Firstly, Drax, where we thought the quality characteristics of the business had deteriorated, and in particular the high level of funding uncertainty after the company's current subsidies end. We also sold the holding in Croda. The company had a couple of profit warnings, and given that the operating leverage was higher than expected, it was losing market share, and the valuation looked full, we decided to sell the holding. And then finally, we sold the small holding in Marshalls, where our concern around the balance sheet had increased. We added 1 new holding during the period, which was Rotork, a mid-cap company and a leading manufacturer of actuators. Rotork has a leading part to play in the energy transition, helping to remove methane emissions and enabling the growth of hydrogen. The company has attractive quality characteristics, such as a high return on capital, a strong balance sheet, high barriers to entry, and attractive margins. So in terms of performance over the last few months, both the share price and NAV per share have performed broadly in line with the market. Over a year, both of those are marginally ahead of the FTSE All-Share benchmark. So in summary, we're very much sticking to our knitting, which is encapsulated in the belief that in order for a company to grow its dividend, it needs to grow its earnings, and over the long term, good quality companies are best placed to do that. So for us, we're focused on maintaining a diversified portfolio of high quality companies that can do well over the long term. Thank you very much for your time.